Let's start with a little economic history. In the 1980s, it used to be said that the higher the business's turnover, the better its performance. Competition boiled down to a battle of the titans. From the early 80s onwards, there was a move to considering that the bottom line was the measure of performance. That's to say, the profit for the period shown in the income statement related to revenues. At least 10% net profit after tax was expected. It was not until the early 90s that the captains of industry became obsessed with new concepts of return on capital employed, comparing overall profit to the economic resources needed to produce it, that's to say, net assets, and to WCR. A rate of 12 to 13% is generally expected by shareholder investors. But be careful not to be blinded by this. Trying to achieve the highest ratio at any cost can, in extreme circumstances, lead to suicidal management that only takes the short term into account and neglects the long term. By no longer investing, while at the same time reducing stock, it's certainly possible to improve the ratio, but it also sounds the death knell for a business. It's not always easy to measure a business's performance, particularly because the concept of performance is difficult to pin down. One way of getting an approximate idea is to evaluate a business's level of activity. The level of activity is initially addressed by looking at the changes in it. Is the business in a phase of expansion, stagnation, or contraction? These movements may be directly linked to the life cycle of the business and of its products. Are they in a phase of launch, development, maturity, or decline? Having an overall picture of the business is not enough. You also have to compare it to other businesses in its business sector. Indeed, a business may be in expansion phase at the same time as losing market share if its growth is weaker than that of its competitors. Three items are fundamental to the measurement of a business's operating activity.
Revenues. These are made up of sales of goods for resale for trading businesses and production sold for manufacturing companies and service companies. These items are also found in the income statement where they appear in the ex-VAT value. Total production. This is equal to revenues plus or minus changes in stock levels plus capitalized production. Note that capitalized production is production manufactured by the business for itself. Finally, value added. This is equal to total production minus consumption of supplies from third parties. These are mainly overheads, subcontract costs, and the cost of temporary staff.
Reconstitute the following ratios from the elements below.
Productivity is equal to activity divided by the resources used. Return on capital employed is equal to operating profit after tax divided by capital employed. Return on equity is equal to net profit divided by equity.
Assume there are three businesses, A, B, and C, in the same business sector with the same positioning in their sectors. With regard to their revenues and their value added, which of them seems the most profitable to you?
That's right. The ratio of value added over revenues is more useful for measuring performance than revenues or value added alone.
The Ruley Goods Transport Company has economic assets of €5 million. These economic assets are financed 40% by equity and 60% by borrowings. Operating profit amounts to €600,000, so what is Ruley's return on capital employed?
The return on capital employed is equal to operating profit divided by economic assets. It is therefore 12%.